Continuing example 5A, we're going to look at requirement 7, a budgeted contribution margin income statement for the quarter ending June 30th, and we're not going to do it monthly, we're just going to do it quarterly. So here's our contribution format income statement. If you remember from earlier in the class, a contribution format income statement has revenues minus variable cost, giving you contribution margin, minus fixed cost gives you net operating income. In this case, we're going to go one step beyond operating income because we do have interest expense that we know about, and so we're going to consider that as well. Our revenues, it's going to be from our sales budget, so our total revenue for the quarter is going to be $3,367,000. Our variable cost, in this case, is going to include cost of goods sold and our other variable cost, which is sales commissions. So our cost of goods sold, we've already calculated our cost of goods sold. By the time you get to your ending financial statements, you've calculated pretty much all the numbers that you need already. So we're going to look at our cost of goods sold, not the amount we purchase, not the cash payments for what we purchase, but the cost of goods sold. That's going to be the amount of our cost of goods sold. Our sales commissions expense for the quarter, we've already calculated that as well. So our total variable costs is going to be $2,092,350. And so our contribution margin for the quarter is the difference there, or $1,274,650. Our fixed cost, here is where this issue of what do we do about our non-cash expense comes in. We want to make sure that our income statement does include our non-cash expenses. So we have to make sure that our depreciation expense is included in our our income statement. So what I'm going to do is I'll just take all of our fixed costs, copy and paste these cells from advertising down to depreciation. And I'll drop in the quarterly numbers for all of these. If you just have your cash disbursements for operating expenses and you don't include depreciation anywhere, you're likely to forget to include depreciation in your income statement, and then your balance sheet won't balance. So our total fixed cost, including our non-cash expense of depreciation, totals $1,011,011. And so our operating income is going to be $263,650. Our interest expense, we can't forget that because we know about our interest expense. I'll call this net income before taxes. We're going to ignore income taxes, so I guess we could simply call it net income in this example. Our net income here is $262,900. Now this looks fairly straightforward, but the one thing that we want to make sure of is we keep things straight. So an income statement doesn't care when cash flows. An income statement cares when the business activity that creates cash flows, when the business activity happens. So we want to make sure that our revenues are not cash collections. We want to make sure that our cost of goods sold is not purchases and not cash disbursements. We've got multiple facets of each transaction. What we sell, we earn the revenue. We also have the cash collection. Those happen at different times. Those are different things. Even though they're closely related, they're different. An income statement cares about revenues. For our cost of goods sold, we purchase our inventory before we sell it. We pay for our inventory at a different time from when we sell it. An income statement cares about the cost of goods that are sold because it's trying to match the revenues with the cost of those items that generated the revenues. So we want to make sure that what we have in here for cost of goods sold is the cost of goods sold number, not the purchases or the cash disbursements. And for depreciation, depreciation is a non-cash expense, but it is an expense. So for all the other expenses we have in this example, we pay cash. There's no difference between the cash amount and the income statement amount. But for depreciation, we have to recognize that it's a non-cash expense. Being an expense, it shows up on the income statement. Being non-cash, it does not get included in the cash budget. So we have to be careful with our non-cash expenses. With those warnings and caveats, this is our contribution format income statement. Now you could just as easily do a GAAP income statement, and really what you would do there is you'd move your sales commissions down to a selling general administrative category. Your total net income would be the same. But for consistency with how we present stuff in this course, with an emphasis on the contribution margin, that's why we have this in this example. Excuse me.